Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate filings. Today, we're diving into the world of Karbon-X, and trust me, after looking at this report, you might be wondering if they're making more progress reducing carbon emissions or burning through investor cash. This quarterly report is a roller coaster, so buckle up. This report paints a picture of a company chasing growth with revenue increases offset by spending. It is a story of investment, high risk, and potentially high reward. First off, this is their quarterly report, something called a 10Q. It's basically a check-in with the Securities and Exchange Commission, or SEC, that shows how they're doing every 3 months. This one is for the period ended in February. Now, before we get into the nitty-gritty, it's good to know that as of April, they had about 84.3 million shares of common stock floating around. Keep that number in mind as we dissect where this company's heading. All right, let's jump right into the numbers there. Condensed balance sheets gives us a quick snapshot of what they own and what they owe. First, let's talk cash. They're sitting on around $930,000, which is a big drop from the $2.6 million they had back in May. Also, their accounts receivable are down. This means that the company might be struggling to collect payments. The value of their inventory has decreased. This might indicate slower sales or difficulties in moving their products. Looking at the other side of the balance sheet, their current liabilities, or debts due soon, have ballooned to $5.7 million compared to just $839,000. A big chunk of that increase comes from convertible notes payable, which are basically loans that can turn into stock. This suggests they're relying on debt to keep the lights on, but it's better than nothing. A new item has shown up on the balance sheet. This is a special type of debt and adds additional complexity to their financial situation. Now, let's see how they're actually making money. Their sales are around $238,000 for the quarter, a little less than the previous year. What really jumps out is their spending. Marketing expenses have exploded, salaries have gone through the roof, professional fees also grew. All this spending leads to an operating loss of $1.6 million compared to $371,000 the previous year. This is the reality of chasing growth. The loss per share is 2 cents. For the 9 months ending in February, that number is 5 cents. The statement of changes in shareholders' equity shows how the company's ownership structure is changing. They issued a lot of shares for cash, meaning they sold stock to get money, but it's costing the original owners. They lost a lot of money, which is never a good thing. They spent a lot of money on equity-based compensation expense. Increase, decrease in Peshtoy, securities restricted, and trading securities are also down. Bottom line, they burned through $4.4 million in operating activities and ended up with $930,000 at the end of the period. All right, let's dig into the notes, which are like the fine print of the financial world. They mentioned something about credit losses. With the new accounting rules, companies now need to predict potential credit losses over the lifetime of what people owe. It's not great, but not unexpected. Here's a point that's worth noting. One of their sales contracts involves revenue being recognized over several years. Specifically, recognition will occur quarterly from second quarter of 2025 through first quarter of 2029, based on the quantities delivered in each period at the rate of 125 per credit. The company engages in the purchase and sale of carbon credits as part of its business operations. They have a sizable prepayment expense related to advertising with the Oilers Entertainment Group. These sorts of promotional agreements need to be amortized, which is basically the spreading out of costs over time and written down over time to count as costs. They have some convertible notes, meaning that at some point the note holders can convert to shares. The conversion price is about 0.78 per share. Karbon-X got shares in another company and made a deal to sell them carbon credits in the future. The value of those shares is determined by market prices, hence they are remeasured. However, their agreement is designed to protect against loss. More deferred revenue, meaning money for which products and service hasn't yet been provided. This represents a huge future liability. They're spending money building a mobile app and the costs are being capitalized. Karbon-X has issued a stock option plan. This is used to motivate and align employees into test in the business direction. They have 4,159,875 outstanding but worthless. Their stock valuation model is based on 5% rate with expected volatility of 35%. Warrants give the holder the right but not the obligation to purchase shares at a specific price within a certain time frame. It's often a way to attract investments but dilutes shareholders. The company has entered into an operating lease for office space commencing on July 1, 2025. The lease payment is roughly $100K per year and has an incremental borrowing rate of 5%. They've made a deposit of about $600,000 for inventory to be delivered in July. Back to that unsecured note worth about $250,000 that we talked about. This note can be converted to cash for a 40% annual yield. After the quarter ended in March, they made a deal for over $1 million in funding to trade in EU carbon-related products. An investor will be providing and accruing 20% interest per year and royalties from this trading activity. Okay, now what does management think about all this? Despite all the issues, management highlights that this company's revenue grew due to the launch of a successful contract. They still are growing through channels such as app subscription. They mention how costs rose due to marketing and other expenses. This increase is essential to continue driving revenue. The company's management admits they can't 100% rely on accurate reporting. There's a lawsuit from a former employee, and there have been disputes regarding investment in previous investments. And finally, Chad Clovis and Christopher Mulgrew, the CEO and CFO, signed off on this report. Now, let's put all the pieces together. Karbon-X is definitely in a high growth mode, aggressively expanding its operations, and market reach, the revenue growth is impressive, and that investment should set the company up nicely. But there's a cost. Their expenses are skyrocketing, leading to big losses, and a lot of it is being funded with debt, which is risky. There is also litigation and poor financial control. What's it all mean? Karbon-X is betting big on the future of carbon credits. If they can keep that revenue growing and show some restraint on expenses, they might just pull it off. Thanks for watching. If you enjoyed this video, please like and subscribe for more deep dives into the world of corporate filings. Let me know what companies you want me to decode next.